Buy term and invest the difference tax-free. In this episode, we are going to address the question, how do I buy term and invest the difference tax-free? This is a powerful strategy that I had a big aha epiphany on back in 1980, and I want you to understand this because this is buy term, invest the difference on steroids. Hi, I'm Doug Andrew, and if you've watched any of my other educational episodes, welcome back. If this is your first time, I've been a financial strategist and retirement planning specialist for 47 years. I've been blessed to write 11 books so far, and we've had many bestsellers, one a New York Times Wall Street Journal #1 bestseller. I would love to gift you free a copy of one of my books, but I want to share with you sort of how I got started. I began as a financial strategist clear back in 1974. And to be honest with you, I was a big buy term insurance and invest the difference proponent. I went around to colleges and universities and to major debates, and I had a very professional presentation where I could show that if you bought term insurance and you actually invested the difference into a typical mutual fund portfolio, how much better off you would be than the same amount of money put into a whole life insurance policy at the time. So come over here with me, and I'm going to simplify this concept and show you that all life insurance policies have a term insurance component in them. And a lot of people don't understand this. They think, well, there's term and there's whole life, there's universal life. Well, let me show you when an insurance company measures the risks and they want you to pay a premium to make sure that if you're one of the ones that passes away, they calculate what the premium is. That's term insurance cost. So let's just do a graph here, and let's say that we'll start out here at age 30. Let's say this is age 30, and over here would be maybe age 100. This is the dollars or the premiums that you have to pay. And so when life insurance, when I started clear back then, there was for a long time a 1958 mortality table, then there was a 1980 table. And I remember that the cost per thousand of term insurance for a 30-year-old was about $2.13. So let's just simplify it. It's about $2. That means if there were 1,000 of us in some fraternity and we wanted to come up with $1,000 for the two families that would suffer because 2 out of 1,000 30-year-olds pass away. And so to come up with 1,000 for each of those, we need $2,000. Well, that's easy. 1,000 people all chip in $2. See, that's the pure cost of insurance. And so it's $2 per thousand. And so what happens is, based on how many thousands you want, every year you get older, there's more and more people dying. 31-year-old, 32, 33. The older you get, more and more have passed away, to where by the time you get to, let's say it's age 65 over here. At age 65, maybe a third back then have already passed away. And so the cost of term insurance keeps going up. And of course, buy term, invest the difference proponents, they say, well, yeah, just buy term, invest the difference, because when it gets really expensive, you don't need the insurance anymore. You'll be self-insured because you've invested the difference. Sounds logical. I used to preach that. Well, what happened was whole life insurance companies said, well, why don't you just pay a higher amount for a 30-year-old, and you just pay one level premium. And so what happens is you are way overpaying the early years, but then you're underpaying the latter years because you sort of built up equity or cash value. So the overpayment here covers the underpayment of that cost going up. And so this creates cash value. And then they said, well, I don't want to pay premiums after 65. And so you pay even more to age 65 and then you stop. That was called paid up at 65. Or maybe a 20 pay. You pay for 20 years and stop. You pay for 10 years and stop. You pay just 1 year. You used to just pay 1 year. And how much do I need to pay the insurance company so that they'll pay out $1 million anytime I die? So that was whole life insurance. You overpaid the early years and then that covered the cost as it went up. But all insurance, whole life, universal life, it all has this actual cost in there that is being deducted as it goes. So the concept is, hey, instead of giving it to the insurance company and earning a measly 2.5 or 3.5% rate of return, why don't you invest the difference? So I would go around and prove mathematically, what if you bought term insurance and paid this, and took the difference between that and this that you would normally pay into a whole life policy, and you put it into a mutual fund portfolio, and I would illustrate 12%, because back in 1980, we did a pretty good job averaging 12%. And then I got this aha. So as I was going around and proving mathematically that if I bought term insurance and I took the difference and put it into a mutual fund portfolio, at age 65, I'd end up with this much money. That would be as much or more than the insurance I had. They still say this, these proponents do that. And then all of a sudden it was E.F. Hutton who said, wait a minute, why are we telling people to buy term insurance and investing the difference into a taxable investment or a tax-deferred IRA or 401k when they're going to have to pay tax at the end of the day? So if they're earning 12%, they're not really netting 12, they're only netting 8. The mutual funds were charging a 1% fee. So you made 12. It was like playing red light, green light when I was a kid. You take 12 steps forward, but then you have to take 4 steps back in tax and another step back in fees, and you're only netting 7. So at the end of the day, I thought, that's not all that great unless you could buy term and invest the difference totally tax-free. E.F. Hutton is the brainchild. They said, let's buy term, invest the difference under a tax-free umbrella. How do you do that? Well, life insurance, like whole life, it is protected under the Internal Revenue Code, where money inside of an insurance policy accumulates tax-free under Section 72E. You can take out the money tax-free down the road under Section 7702. When you die, anything in there blossoms and transfers out in a death benefit tax-free under Section 101A. It's tax-free. And Hutton said, what are we thinking? They said, let's buy term and invest the difference on steroids. So what they did is they created a universal life insurance concept where you could pay in the money into the policy, even more than a whole life policy if you wanted to, and you could maximum fund this thing in 5 years is what they ended up deciding on after 1988. So you could put in as much as 5 years and just load up the policy, and the amount of money in here is so great that the interest that they are earning on your money, because you're linking it to an index like the S&P 500 or the Dow Jones. But if the market goes down, you don't lose because your money's not in the market. The insurance company is just paying you whatever the market does with the interest they're earning. This is explained in other episodes. So over here, if you had $1 million and it's earning 10%, which I've averaged on mine for the last 25 years, 10.17. On $1 million, you got 100,000 of interest. The cost of the insurance might only be 5 or 10,000. I'm making 100,000 in interest. The cost of the insurance is only 5 or 10. So the difference is growing. The whole idea Hutton was credited with his let's buy term. It's in the insurance policy. It's in all insurance policies, the term component, but the difference is now growing tax-free. I can earn 12% tax-free and it stays at 12. If I earn 10, it's worth 10. If I buy term, invest the difference in mutual funds, I'm not netting 12. In fact, most people aren't even averaging 12 in the market. If you could earn 12, you're only netting 7. Why not put it into an insurance policy and earn 11 and net 10 like I have, and it's tax-free? It knocks the socks off of buy term, invest the difference in a taxable environment or a tax-deferred IRA or 401k. The whole concept of indexed universal life, the brainchild of E.F. Hutton, let's buy term and invest the difference, but let's do it totally tax-free, and we'll dramatically increase the rate of return, and you will be self-insured. In fact, most of my policies within 10 years, the cost of insurance is totally covered forever from a minuscule portion of the interest I'm earning. The cost of insurance actually goes down not up. The amount of risk that the insurance company is covering is less because the money now, the death benefit, is 95% my own money. If you've never seen an insurance policy that gets cheaper as you get older, you need to read my books, you need to look at other episodes, get a copy of the Laser Fund. Click on this video, watch this episode, and you'll be given the opportunity to get a copy of the Laser Fund, absolutely free, 300-page book. You just pay $5.95 shipping and handling.